Welcome to episode 6 of Barely Bullish Investing. This one is Barely Bullish Investing takes on the US dollar and a little bit more in bonds.
Yeah.
Because it's hard to talk about one without the other.
Yeah. So, Michael, what would you say is the definition of the dollar?
The definition of the dollar. Well, a lot of people will say these days it's based on the full faith and credit in the United States government and the United States Federal Reserve.
Yeah, I don't know. I think it today is more like full faith and partial credit. But we do as a nation have full faith in credit. I like those two more. I think they're more accurate than full faith and credit. Oh, sorry. Yeah, in the U.S. government anymore. So
I think you make a good point there. What I challenge everyone watching today to do is to try to change the way you think about the U.S. dollar. We're all used to thinking about the U.S. dollar as this unchangeable, non-malleable thing. You can count on it. You can literally count on it. You can count with it, right? Okay. We're used to thinking about it this way. We think about everything in terms of dollars, and it's an old way of thinking, and I think it's outdated. I think it's outmoded. I think it's antiquated. And the reason I think this is because we are already seeing large fluctuations of the value of the dollar, right? And all the things tied to the dollar. And as you have those fluctuations, as you have the dollar system abused by an uncreditworthy United States government and discredited United States government, discredited Federal Reserve System, which I have no faith in. I personally have faith in God, gold, and guns.
Yeah, the 3 Gs.
The 3 Gs. Dollars, not so much. But as we see the store of value or the dollar fluctuate inappropriately due to all the manipulations that are done to it, it's going to be harder to reliably measure things in U.S. dollars. I think it was Steve Forbes who put together this really interesting analogy of trying to bake a cake but not using a standard temperature or standard time, right? And that's what we're doing with the U.S. dollar today. Mike Maloney's Hidden Secrets of Money points that out too.
Yeah, it is interesting because it's not. I mean, it is It's natural to think of the dollar as a discrete, objective measure of something, and discussing it with you, it's really important to think about it more, especially now with such huge amount of devaluation of our currency in the last few years. It's better to think about the dollar relative to other currencies and measuring it that way. I think we were talking about the DXY, and there was another well, maybe that's not. Would the DXY be a good representative?
DXY is a proxy measure. But before we even get to that, I just want to say it's important to think about the dollar in a couple of different ways. And here are some ways to that's flexibility exercises in thinking about it differently. The first would be thinking about it in terms of being a cross-pair exchange with other things. That is to say, instead of looking at the price of let's say, euros and dollars, and the price of oil in dollars, and the price of corn in dollars, and the price of yen in dollars, think about all those just as individual relative pairs trading against each other. And try not to think too hard about valuing the corn in yen through dollars. Just think about them as individual pair trades, right? It's one way to think about it.
It's tough though.
It is tough.
Because I don't know, I think it would be easier for me to think about it in terms of 1 grain of corn is worth this many dollars, and then the same grain of corn today is worth this many euros or whatever currency you want to, and then compare those two prices for the same quantity of a good.
Right.
I think that's a little less abstract.
It is. I understand that, but we're forced into this plasticity, this mental plasticity, because we're going to see these fluctuations. We already are seeing these fluctuations, but we're going to see them become more dramatic. And if we're stuck in thinking about everything in dollars, we're going to be in a big mistake. Another way, probably an easier, more intuitive way, might be instead of thinking about how many square feet you have in a house and how much you're paying in dollar per square foot, maybe think about unit of time you work in dollar per square foot, or barrels of oil per square foot of house that you're buying, or gold, ounces of gold or silver per ounce of square house that you're buying. Those things are more stable over time, or even bushels of wheat in the amount of house you're buying, things like that.
Okay, I'm going to challenge you on something. I don't know that they're more stable, Because don't those prices of commodities fluctuate also? Probably more drastically than the dollar does.
They too, but if we have a currency crisis, which I think we're lined up to have in the U.S. dollar, the fluctuations in the dollar are going to make current commodity and past commodity fluctuations look like tiny little ridges on a graph or a chart compared to these massive fluctuations in dollar prices.
Almost like becoming in a sense, it's almost like considering it in terms of bartering, basically.
Yeah.
All right. Interesting ideas.
Or if you don't like the fluctuation of individual commodities or individual other currencies, you can always create baskets. There are indexes out there that you can look at, like commodity indexes, that you can try valuing things in. But that's probably another discussion. I'm just saying let's get away from thinking about the dollar as a way to measure things, because it's a measuring stick that keeps changing in length, and it's no good.
Yeah.
The other way to maybe think about the dollar is to think about it in terms of duration. So people are pretty comfortable with the idea of a 30-year fixed rate mortgage or a 30-year fixed rate United States Treasury bond. That's fine, but you also have different durations. You have 10 years, you have 5 years, 2 years, you have 3 months, 6 months. I would challenge you to think of the dollar not as the dollar that's in your bank account or even the dollar that's in your hand. I'd encourage you to think about it as an overnight instrument or an overnight debt instrument that you're holding on to that has the same counterparty risk as bonds, that has to be paid ultimately in value, that it gets its valuation ultimately from the hegemony of the United States government, and that is subject to all the same risks and fluctuations that bonds are, but just on an overnight basis.
Yeah.
Which, like bonds, you do get paid a certain interest to hold in nominal terms, especially if you have a bank account. But in real terms, of course, just like bonds, in an inflationary environment, dollars decline in value. But I'd encourage you, and I think the person who originally suggested that, as I recall, might have been Danielle DiMartino Booth, but I'm not 100% sure. So credit where credit's due. This is not my original idea, but I like it very much. Mm-hmm. Yeah.
And the Dixie. Is it time to talk about the Dixie?
Oof, you want to talk about the Dixie? All right, why don't you tell us about the Dixie? And does it have to do the Mason-Dixie? Is it a Mason-Dixie line? No?
I wish. No, actually, I don't wish. But, I mean, look, I'll be honest, I'm not all that familiar with the Dixie. I know that you follow it a lot closer than I do, and I'm sort of just dipping my toes in to understanding it. But, I mean, I do understand the basics, that it is a way to measure the US dollar against other currencies. I'm pretty sure it's mostly the euro it's measured against.
Right. No, you're exactly right.
But I know it's usually either one or some fraction of one, right? Like, is it always under one when it's measured? How is it measured? Like, what kind of
If I understand it correctly, it's indexed to 100.
Oh, okay.
Yeah.
I don't know.
I believe so.
I don't look at it. I don't follow the Dixie like on a regular basis or anything. Right, but I do understand that it indicates the relative weakness of the dollar to mostly the euro and other currencies.
Right. It's 57.6% the euro, 13.6% the Japanese yen, 11.9% the United Kingdom pound sterling, 9.1% the Canadian dollar, 4.2% the Swedish krona, and then 3.6% the Swiss franc.
I think you mean a Swissy. We were watching something recently and they call it Swissy. It was a financial thing too. Okay, never mind.
All right. Okay, so the Dixie is basically a measurement of a basket of currencies against the United States dollar, which means it's not really the measure of the dollar itself. There's no absolute measurement. Like I said, the dollar is measured, as is any currency, it's measured against other things that you can pair it up against. Right?
And when they're all fiat currencies, it's like a complete mess. I mean, it's so difficult to follow, really.
Right.
But
well, if you're not actively engaged in the import-export business or trying to run the economic affairs of a country or trying to trade the foreign exchange or forex markets, there really is no reason to pay attention to any of this. Except to understand that the long-term implications that it has, and that the Dixie is not an exact, absolute measurement of the value of the dollar, right? Because, as you pointed out correctly, it's being compared to other currencies. The alternative...
Would the Dixie be the best way for people, everyday people, to understand the current value of the dollar or strength or weakness?
I don't think so.
Okay.
No, because there are a lot of things, we'll discuss them shortly, but there are a lot of things that can influence the value of the Dixie. There are two ways to look at it. Either the value of the dollar is going up or down, right? Or comparatively, the value of one of those other currencies is going up or down. The most dramatic example would be if let's say, God forbid, a nuclear bomb hit Germany, let's say, which is the main country in the European Union that produces the most stuff, and their productive capacity goes way down. Well, if their productive capacity goes way down, the euro is ultimately tied to the productive capacity of all the nation states who use it. So if Germany's productive capacity goes way down, you'd expect the Dixie to go up, right? Because the value of the euro would go substantially down.
Right.
That's to use a very dramatic example just to illustrate it.
But that has actually nothing to do with the economy or the dollar. Here, it's just an effect of the relative weakness of another currency.
Right, exactly.
Right.
And it technically would have something to do with our economy because international trade, I'm sure there are plenty of companies who buy things from Germany to produce their things. So
right, that would divert business.
Downstream effects. Yeah. But the main effect is going to be a decrease in the value of the euro.
Mm-hmm.
Yeah. So the Dixie and what I'm about to mention, the Bloomberg Dollar Index, they both measure the relative value of the dollar against other currencies. They're really not helpful for determining the absolute value of the dollar.
Okay.
But at the same time, many trading algorithms and many trading investment houses, fund managers, they'll keep an eye on the Dixie because even though it's a relative measure, if you do see the Dixie go up, it could be because there's the intrinsic strength in the U.S. dollar and that the Dixie is trading around, in the sense that people are intentionally selling the currencies against which the Dixie is based on, the DXY, and they're using it to buy dollars. So the Dixie can reflect that, but it's not an ideal measuring stick either.
Okay.
The Bloomberg Index, it's the dollar against 32.65% euro, 14.64% yen, 11.49% the United Kingdom pound sterling, 11.94% Canadian dollar, 9.95% the Mexican peso, 5.15% the Australian dollar, 4.78% the Swiss franc, 3.43% the Swedish krona, 3.00% the Chinese yuan, and 2.96% the Indian rupee. What staggers me about both of these indexes, or what I think is very interesting, is that these indices are very Eurocentric and Japanese-centric and British, Great Britain-centric, Canadian. But if you look at the international highest to lowest on GDP, it's basically the United States and then China. Yeah. And China's left out mostly out of both of these indexes, although the Bloomberg Dollar Index includes a little bit of them. And in part that's because China's tied to a peg, but I think the greater reason, well, I don't know what the reason is exactly, but the higher GDP nations, many of them are left out of these index currency pairs.
Well, aside from China, with the other ones who don't have a peg to the dollar, if they were on this index, would their currency compared to the US dollar, I guess, be stronger? Meaning that this index would look not as healthy for the US dollar had these other countries been added.
That's a good question. I'll be honest, though, I have to think about that a little more because I'm not really sure. Yeah.
I do wonder what led to these specific percentages of these specific currencies.
The constitution or the composition of the index?
Yeah.
Yeah, that's a good question. Maybe we'll do some research on that if people are curious enough, and we'll report on it subsequently. So now that we've covered the Dixie and the Bloomberg Dollar Index, we're going to probably spend most of the rest of the time here discussing the things that the dollar is used for in the modern economy, again, from different perspectives, not just the retail United States consumer perspective. And then the factors that will help or could help to increase or decrease the value of dollars relative to other things, like, for example, other currencies or other investments. And that's probably leads to the third way of thinking about the dollar, which is kind of related to the second, of thinking of it as an overnight treasury bill. You can think about the dollar as not really a store of value per se, but an investment, right? So if you're going long the dollar or short the dollar, Long the dollar is you hold on to more dollars. Short the dollar, you get rid of dollars, basically, right? Mm-hmm. So you can kind of think about it in that way, and especially in terms of investing and portfolio allocation. We've previously described situations where it's important to have a certain reserve of dollars. Okay, fine, for personal use. And many advisors, not that I'm advising or recommending anything, but many advisors will say generically it's not a bad idea to have what's called dry powder, or a reserve of liquid US dollars or dollar equivalents available in case you want to buy other investments. So
right.
my last suggestion to kind of wrap your brain around dollars in a different way is to think about them as an investment. I'm 10% long the US dollar, 10% long stocks, 10% long real estate, whatever. Think about it as an investment class.
Yeah, that's definitely a different way of thinking about it. Mm-hmm.
So what are dollars used for these days? They're required to service debts, right? And they call that dollar-denominated debt. And obviously that's the case in the United States. If you have a mortgage or a car loan, you have to, or a credit card loan or student loans, whatever it is, you have to pay debts in US dollars. If you have a tax debt, right, or just a tax, right, that's paid in US dollars, right?
Right.
But what's not so obvious is that, not with taxation in some countries, most countries, but with trade and debt settlement, in a lot of countries, they settle their debts, or they have their debts in US dollars. Internationally,
among countries.
Right. So you can have a situation where a company or an individual in Thailand wants to borrow some of the Thai baht, and they don't pay back in Thai baht. They borrow dollars and they pay it back in dollars because the Thai baht is less stable. The idea, and that model has worked for a long time, because generally speaking, the dollar was more stable than a lot of so-called developing country currencies, where their political regimes were less stable, their economies were less stable, their socio-political environment was less stable, or even geopolitically, they might just get invaded by a neighbor, right?
Right.
Where the United States doesn't really have that risk, or at least not as much.
Yeah.
Yeah. So a lot of debts are denominated in dollars, and so you need dollars to pay off those debts, including internationally.
Yeah.
And of course, you need dollars to pay taxes. Also, kind of on the same vein, dollars, any currency, functions in an economy as the oil for the engine, the lubrication. It allows for transactions to go through, right? So it's obvious if you want to go get an Uber ride somewhere to go to a restaurant, and then you come home from your restaurant and you decide to watch your subscription TV service, whatever, and then that's before you go to work the next day where you're paid. All those things use dollars, right? So their dollars are pervasive throughout the system to allow people to transact in the economy, which is the point of currencies.
Right.
Yep. And in a general sense, in terms of monetary supply, you want to have more dollars or more currency when you have greater amount of economic activity, and you want to have less currency when you have lesser economic activity. That way, the dollar's store of value in terms of economic energy and economic activity remains the same. All the modern economics schools agree with that general principle. However, they differ in their solutions. The Keynesians and the monetarists will say, okay, if you have lagging or flagging economic activity, if you have a depression, if you have or a really bad recession, if you flood the system with dollars, then that will encourage spending. And with countries with low debt to GDP ratios, that has worked in the past, including the United States. However, those remedies have limits, and it's not really even clear how necessary they are. The Austrians will tell you, yes, you might get some short-term gain from that, but in the long term, it's going to cause an inappropriate expansion of credit, which will then collapse the system hard and unpleasantly, and extend the negative consequences of the natural business cycle. When you have a boom leading to a bust, the busts are harder if you've flooded the system with dollars. Yep.
But are there ways to do that? To have, I guess, federal and monetary policy would be a way to try to control the supply of dollars relative to the health of the economy.
In theory, you could. In theory, you could measure, although measurements of the economy are perfect. The system is riddled with imperfections. GDP is not a perfect measure of the economy. It's unclear what you should measure in it, especially government spending. That's very controversial. Mm-hmm. So there's that. It's hard to measure, it's hard to measure the productive capacity, and it's also hard to measure exactly how many dollars are in the system. Think about it, how you'd measure it. What do you take? The aggregate amount of bank accounts? Okay, well, that's not going to count
all
cash
the credit.
people. Sure, it's not going to count a lot of the credit that's been extended. There are different measurements. There's M1, M2, M3, and they're published, but they all have problems. And none of them can account for unknown dollars in circulation, right? So if you've gone, somebody's a drug lord has gone off and buried, $500 million off somewhere, that money can't be accounted for, or the currency can't be accounted for, right?
Yeah, until it's brought back into the system. Yeah.
Right. Yes.
But basically, what you're saying is that in a perfect economy, there'd be less dollars when we have lower economic activity, and there'd be more dollars when we have higher economic activity.
Right.
And that's not just talking about the dollars that are in circulation. That's what I was looking for. Because obviously, I think that naturally happens when the economy is not as productive. People are not spending as much. They're holding dollars outside of circulation at home, in banks, wherever, in savings. So you're talking about not that, but rather the entire, not just the circulating currency, but the total supply of currency.
You bring up an interesting point there, and this is something I don't think anybody really has a clear answer to. And the reason for that is because it's hard to run side-by-side controlled tests. You see it every once in a while. Like East and Western Germany were fantastic for this. North and South Korea were the same. It's hard to make take specific economic principles in one area and then apply them empirically to the other and control for all the variables. But the real question is this: is it necessary for there to be an external intervention in terms of monetary supply to adjust the supply of dollars or whatever the currency is based on the stage of the economic cycle, or will free markets and people themselves as individuals in aggregate automatically self-regulate, so that when times are tough they do hold on to dollars, and their holding on to dollars indicates their lack of willingness to participate in the economy? And is that cycle necessarily self-reinforcing? The nightmare that the Keynesians will tell you is that once you're in that stage and the government does not do something to intervene, that free markets will not automatically in aggregate fix that problem, that people will just permanently for endless decades and centuries simply not spend, not invest in new businesses, not invest in new agricultural pursuits, not try to go out and produce more things because you're in a depression. I don't know that carries water. Because then, if that's the case, then how did an economy ever spontaneously develop in the first place?
Right. Because there wouldn't have been any external regulation of that econoamy. Right,
and certainly this is all before there's any currency or monetary supply.
Right.
So I don't know how necessary that is, and certainly it raises it as an interesting question in terms of politics, because one of the functions of any state is to issue some currency, and the whole point of having that currency around is to have a known measure of something that can be agreed upon and is not counterfeit, right?
Yeah.
I would argue mintage is still the best way to do that. If you have a mint strongly enforce with the rule of law the purity of, let's say, gold or silver, or even another metal or something else. If you had some mint doing that really is the ultimate function of the state, the primary one. I'm not sure that it's necessary after that point for them to determine the amounts. Obviously, if there are too few, for example, if the entire economy of the United States only had $5 to work with, it would be impossible. But then again, if we only had $5 to work with modern computing technology, we could be trading in 1/4,000,000th of a dollar all the time.
And I almost wonder if the supply was constant. I know people say, it's important to have at least a slow but steady increase in the supply of currency for stimulation of the economy and economic growth. But I almost wonder if the reverse could be true, where if you have a digital currency anyways, and you have a set supply of that currency, then could it not just be, at least in theory, that things become valued at lower increments of that unit of. Does that make sense? So therefore, it's not deflationary necessarily.
That is deflationary.
Oh, it would be?
By definition.
But couldn't it still be stimulatory?
It could be. Well,
if the economy, if trade is still, like, the transactions in total are increasing, and the economic circulation of currency is increasing, even if the quantities that are being traded are smaller.
You're saying the velocity of money goes up even if there's a static or decreasing supply of money relative to the productive capacity of the country.
That the supply would be static, but because the economy is growing, we see almost like a decrease in the price per unit of any good or service.
So the situation you're describing there, and this is back when these were the only things that were digits.
Oh,
digits. Back in the 1800s, that's exactly what the environment was. We had a long-standing deflationary trend there. It was correlated with, and probably also causally related to, the greatest productive time in our country's history. As Peter Schiff points out, and he's exactly right.
I mean, I haven't thought about this before, but to me that just seems like a better mechanism for monetary policy, to have some set amount and then to have prices just decrease for people as the economy is growing and becoming more. I mean, especially since we have digital options.
What that does is it rewards saving and prudent investment.
Right. So, I mean, do you think does that make sense to anyone else, or is that something that people talk about, or
not enough, probably? But governments don't like it because governments are not they're not good at saving, and they're not good at prudent use of money or currency. And in fact, they're deadbeats, and they don't want to have to pay their debts back.
Well, that would probably require them to pay in full faith and credit.
Right.
Okay, so they like the dollar the way they have it because it gives them a little wiggle room.
Yeah.
And I guess Keynesians wouldn't like that because they believe that by adding more to it, you can stimulate that circulation.
Right,
so,
right.
I don't know.
And let's understand too, Keynesianism is based on the thoughts and feelings of one guy's take on classical economics, and it's supposed to have been used to explain the Great Depression and why it lasted so long and how we got out of it. And I simply don't believe it. I've read their arguments. I don't think they survive empirical testing. That's an entirely other subject, and maybe one day we can do a deep dive into that. I'd be happy to. It's something that interests me a lot. But I think a lot of their maxims don't work, and I think at the very least, one of the key areas where Keynesianism completely fails to explain anything. Well, long story short, they predicted that it would be impossible to have economic stagnation or stagnated economic activity in the context of inflation, and that maxim was proven wrong in the 1970s when we had stagnation and inflation, stagflation. So they've already been discredited. I have no idea why people keep using them, except that it's convenient for governments to keep printing money, and they'll just rely on whatever crutch they need to do that. I think it's a pseudo-intellectual pursuit, and I think it's a false rationalization that allows people who want to do absolutely crazy things to do it anyway.
Yeah, that's interesting you brought him up, though, as a person. I don't want to go too far off topic. I know you said we got to bring it back, but I do think it's interesting to point out. I don't know, a year or two ago, I read a little bit about Keynes and a guy with the last name White. I think his name might have been Harry White. And John Maynard Keynes, and Harry White was an American. I think John Maynard Keynes was somewhere from Europe. He was European.
Snobs will tell you it's Keynes. Lord Maynard Keynes.
Okay, well, he was European.
But we're America, so it's Keynes.
Keynes. Sure. Well, okay, let me just share this, and we'll go back to talking about the dollar. But
sure.
John Maynard Keynes was European, and there was a guy, I think his name was Harry White, but it may have been a different first name, but his last name was White. He was American, and they had some conference, I think in the United States after World War II.
Sorry about Bretton Woods, I think.
Yes, I think that might be it. But the point is, there was a huge debate about how to handle the shift towards global currency circulation and how they should handle transacting internationally. And John Maynard Keynes really wanted there to be one global currency, or at least one currency that like all of Europe and the United States were using to transact.
One currency to rule them all?
Yeah. And this guy, I think his name was Harry, but definitely Mr. White, he said, no, we're going to use the US dollar as our like way of transacting. Mm-hmm. And that the United States was going to have the dollar, and they could do whatever they wanted, but he really pushed for that, and he actually ended up winning this debate that was like some big deal at the time, and it kind of really shaped how the dollar has come to be used, not exclusively, because I know there's other circumstances that create our dollar as the reserve currency, but that was kind of a big thing that happened. Now looking back, I'm not sure it was the best thing. I think one currency might be much simpler for people to understand. personally.
Yeah.
But sorry, just a fun fact.
Too bad now that I'm just advocating gold because we already had that one currency.
I know. Well, I think this must have been after we were leaving the gold standard. Or right when we were leaving, I think.
No, we're still on it technically, but we're already starting to default and renege on it.
Yeah.
All right, so,
carry on.
No, it's an interesting aside. But to get back to where we're at, let's move on to different factors that can cause dollars, especially looking at it as an investment, to increase or decrease in value, right? There are many of these, and I'm going to give we're probably going to cover some kind of generic or general examples, and there are a lot of nuances to it, and there are even, if you wanted to be nitpicky, you could look at some of these points that we bring up and point out how in very specific circumstances, sometimes the effect wouldn't occur or even could occur paradoxically in the opposite. But as general rules, kind of looking generally at things that can affect the value of the dollar, I think these are worth considering. So the dollar can decline in value if there's a substantial amount of debt defaulting, right? So there's a lot of debt out there in the system. In fact, there's trillions and trillions of dollars of it, many, being held internationally, being held by the United States, by private entities everywhere, personally, consumer debt too. If debts are defaulted on, especially in the context of a liquidity crisis or a credit crisis, so the value of the debt goes down, it's marked down to market. That's number one. Those dollars basically go to money heaven. In a way, they're technically transferred to real assets or to other things, but the value of those debt instruments goes down, and the need to have dollars to pay off those debt instruments, it goes down too. I'm not hearing a lot of people, even in some of the alternative media, talk about this. But if there's a substantial decrease in debt valuation and people walk away from their debts, and they're no longer going to require dollars to service those, that especially is in the case of international debts.
If they default on their debt, that's less dollars. That would strengthen the dollar, right? There'd be less of them. So, but no, because there'd be less demand for them.
Well, specifically in the context of a liquidity crisis, other companies or countries that could transact in alternative currencies or other currencies, if they're reneging on their dollar-denominated debt, then they don't have to scramble to get dollars using their local currencies. They can renege on their debt and they can continue transacting locally in their other currencies. Or if there's another currency or a money that they can tie their new business to, they'll renege on their dollar debt and they'll go straight over to that new currency.
Right, so
that new money.
They have no interest in holding dollars, basically.
Potentially, and also they won't pay their interest if they owe on the dollars.
Well, okay.
Today's episode is going to be lots and lots of bad puns.
Well,
in case you haven't already noticed.
I think that's always every episode.
The next one will be if there's a significant amount of inflation. This one's pretty straightforward. If you have an X amount of dollars, and then let's say you double that amount of dollars, and you have 2 times the amount, 2x of dollars, then all things being the same, each dollar will have half the value that it once had. So inflation, or the printing off of additional dollars beyond the productive capacity of the economy, is bad for dollar valuation. Okay, and all of these things that decrease the dollar valuation should, assuming other countries were static in their approaches to monetary and fiscal policy, should cause the Dixie to go down. And oppositely, all the things that cause the dollar to go up or to be needed in greater amounts should cause the Dixie to go up. But as we described before, the Dixie is not just a measure of the dollar action, it's a measure of the euro action largely, and other currencies as well.
Yeah.
So moving on to the next point of things that can cause the dollar to go down in value. If there is a currency or money that's brought out as an alternate to the US dollar for international trade, or even for domestic trade, we could go to any system that's more reliable than the dollar, if there is one that comes, especially a gold-backed one, or a gold digital-backed system, or a commodity-based currency internationally. I think we talked about previously how in the 1970s, to encourage investment in U.S. bonds, in the 1970s, the U.S. government had some of those bonds denominated in Swiss francs. Ooh, that might happen again. Or maybe people will be expect to be paid in a currency or a commodity or a money that's more stable than the dollar. That could happen if there's aggregate demand for it. Or businesses might choose to transact. In the United States, in an X dollar currency or money. Again, if that's very strongly backed. So any of those scenarios where a real money is brought into common circulation, especially real money brought into common circulation that's easy to use, that could happen. And we'll do a separate episode on this, and I'm not trying to get into the whole cryptocurrency debate, but in theory, if you had a cryptocurrency that could maintain a stable value enough for transactions, it could replace the dollar in routine transactions. But the energy costs would have to be low for that, or non-existent, as low as dollar transaction costs are today, and that's a tall order to fill, but could happen.
Yeah.
Another thing that'll decrease the value of the dollar is if there is a decrease in taxes. And the reason I say that is because taxes take dollars out of the system. And so if there's a decrease in taxes, fewer taxes, more dollars are left in the system. And more dollars being left in the system is ultimately an inflationary pressure.
Yeah. Which would weaken the dollar.
Yes.
Assuming no other currencies have higher rates of inflation, well then relative to those other currencies, the dollar would still be strong. It's very abstract, but it makes sense if you think about it. It's just, to me, it would have made sense just to have one currency,
right?
Instead of all these different currencies that you have to try to measure one another.
Well, that's how it used to be. There used to usually be a predominant currency that was used in most international trade, and then every once in a while you'd see local variations of that, but they don't have a metallic base to them.
Yeah.
Right.
But anyways, taxation, in theory, would be if there's a decrease in taxation, it leaves more dollars in that circulation, therefore weakening.
Not just in theory, of practice. I don't want to get into this very much, but recently there was an episode with the temporary British government, and they tried to decrease taxes when they already had an inflationary environment, and the bonds, the gilts, the British bonds, sold off in such large amounts, it almost broke the pension system there.
Yeah.
And the government had to step in and reinstitute quantitative easing to deal with that and try to buy those gilts back down to get the yields down to support the pension system.
So tax
policies, not just in theory, it's in
impactful.
Practice, very impactful on inflationary versus deflationary pressures.
And the strength of the currency.
Yes.
Okay, carry on.
Most importantly for the dollar is ultimately a decline in valuation when people, and this is an eventuality that will occur, the really big debate is whether it'll occur potentially in 6 months or 6 years or 60 years, but when enough people, a critical mass of people, decide they're done with the screwing around with the dollar, they're done with the volatility, the fluctuations, they're done with the chicanery, they're done with the social engineering, they're done with everything. They just want to have a stable monetary system they can use. If enough people decide that in aggregate, the dollar's history. They're on to something else. Mm-hmm. And when things happen like that, historically, it's always been one of those moments where just society has a paradigm shift, a frame shift. I don't think we're there yet. Enough people, even people watching this, I think we're just a pair of lunatics talking about currency ad nauseum, and that what we're saying is impossible. Oh, the dollar, it'll never happen to the dollar. U.S. strength, U.S. military strength supports the dollar, blah, blah, blah. I've heard all your arguments.
Well, geez, give him a chance.
All right, fine.
Still,
maybe you'll prove me wrong.
Make your argument.
You know where the comments are. I'd love to. Actually, if we get some really good, vigorous responses, I'd love to have some debates on this. Mm-hmm. That could be pretty interesting, and I'd love to address it in future videos. So please, if you think I'm wrong, which you probably do, let me know why. I don't mind.
But anyways,
I think
people probably watching this think this is not even this is not a possibility.
Right. But it is. It certainly is. And once it happens really fast, and it just takes a critical mass to get tired of this. So factors that could cause the dollar to increase in value, right? And I'm not a permanent bear on the dollar in an abstract sense. Theoretically, maybe it's possible to still bring the dollar back, or bring the system back into line to support maintain dollar valuations. I think politically and economically it's very hard to pull off, and there's not the will to do it, but it could happen.
Well, I don't know. I mean, as you're discussing all this, I'm thinking to myself, it all is relative. So if the entire globe, I mean everyone right now, is just coming off of the pandemic, and all of the inflation is, it's a global problem. So, I think our dollar, relative to a lot of other currencies, has still remained strong.
Well, okay.
So,
yeah.
I'm just saying, I know that you're saying, go ahead, sorry.
No, it's a good point that you're making. I think you've succumbed to a little bit of the propaganda there, because a lot of people are blaming the what they call the pandemic, which I think is more appropriately described as an endemic or a pseudo-pandemic. But putting that aside, they blame that for, and then recovering from that for the inflationary pressures. What that fails to take into account is that every government in the world, certainly the Western government collectively, printed off massive amounts of currency units.
Yes.
In the United States, they rose 40%. In many other countries, 20 to 40, 60% rise on pre-pseudo-pandemic or pre-endemic
money supply.
Money supply.
Yeah.
So
you're hanging up on the word choice of mine, but I understand the policies that were put in place due to the pandemic have caused a lot of inflation all over, especially like you're correct, the Western world. So but
more so in other countries than the United States.
Yeah,
your point's taken.
So I'm just saying, even in bad times, oddly, I don't know if this is true, but is our dollar stronger now than it was before the pandemic? Possibly. As far as relative to others, like as far as like the Dixie goes, for example. Right. Okay, but carry on. You were trying to make a point.
Well, certainly it is, as measured by the Dixie and the Bloomberg Dollar Index. It is. I can have my opinion, but I can't have my facts, like Jim Rickards would say. It's actually true. You look at the chart of the Dixie; it's much higher than it was before the endemic.
But you were saying you wouldn't be mad to see the dollar strengthen, but there's these are circumstances that you could see it being strengthened.
Before we get back on track to that, I just want to make the point that the big difference between the dollar and other currencies is that the dollar is a reserve currency in other countries, right? So if a smaller country, Argentina is a perfect example, if they decide to print off a lot of Argentinian pesos, hey, that's fantastic. When that happens, it's not fantastic. It's actually horrible. I'm sorry.
Right.
It's that's their decision if they want to do it, is what I mean to say by the word fantastic. Okay, yeah, they've done that. And the effects of the inflationary impulse becomes immediately apparent. Because there's nobody sucking Argentinian pesos out of Argentina to go fund their purchases of Canadian maple syrup. That's not happening. Right. I mean, maybe there's one oddball doing it. I don't know. But in a general sense,
their pesos aren't being exported out to dilute the impact.
So the inflationary impacts are more immediate and they're more obvious.
Yeah.
Right. The U.S. dollar can do that. We can still get away with that because there's enough external demand for our dollars. If there wasn't that external or international demand for our dollars, we would not be the stronger currency.
Good point.
Because the amount of dollars have gone up relative to our productive capacity. And the only reason we're getting away with this is because other people are accepting our diluted dollars and giving us byproducts of their productive capacity.
Yeah.
That game's going to stop sooner or later.
Yeah, that's not going to be a good day for America.
No, it will not. So factors, though, that could go in the opposite direction that could cause the value of the dollar to increase. They include austerity measures, right? The government stops spending. That never has happened before in history, and I'm almost certain will not happen today.
Wait a minute. I'm going to pose a question to you.
Okay.
Wouldn't you say that there were austerity measures in place in the 70s when we had really high inflation and then, Paul Volcker, did he not implement austerity measures during that period of time where we had high interest rates?
So that wasn't austerity measures. That was well, you could argue they're austere. And when I say austerity, I'm talking about fiscal. So there's fiscal influences or impacts, and there's monetary impacts. Theoretically, they're supposed to be detached. They're not at all. They're both very much intermingled. Always have been and always will be. In fact, the creation of the Federal Reserve or central banking system, we've had three now. This is one of the third national bank. The first two, their charters expired, thank God. This one we didn't write a charter into, so it's around forever now. Great. But the third national bank, also known as the U.S. National Bank, also known as the Federal Reserve, they're supposed to, that's who Paul Volcker was the head of, and he just raised interest rates to try to decrease inflation. Which
was austere, but that is not what you mean when you say austerity measures.
The classical concept of economic austerity is the lack or the decrease of fiscal spending by government. So if we were to be austere, we would say, okay, we're going to cut all of our federal spending down by half. Just get rid of half of everything. Nobody wants to do that. Everyone's going to complain about it. Even though it is, in aggregate, the best thing we could do, nobody's going to go along with it.
Keep taxes high or where they're at. Yes. Don't decrease taxes because of inflation, but maybe put more of that towards debt and spend less.
Yes.
And that would be by definition what you mean by implementing austerity measures. Okay, so that's one way to strengthen the dollar.
That could do it. Yeah, and then I guess secondary would be the monetary side, which is what Paul Volcker did, and do some combination of things. Raise the interbank lending rate, which is technically what the Fed funds rate is, which was what he did. These days, it would be that and or what's called quantitative tightening. The Federal Reserve owns, at the height of it, I think it's about 40% of all the houses in the country through mortgage-backed securities. Now I think that number is a little closer to 35%. But they bought a bunch of mortgage-backed securities, the Federal Reserve has, and they bought a bunch of U.S. Treasuries, monetizing the debt. Quantitative tightening is necessary at this point because the Federal Reserve shouldn't own these things, right? And they need to sell them off, right? It's very unnatural, improper, and a lot of other things for a central bank to own so much of the country or so much of the in terms of bonds, the future productive capacity of the United States citizens and taxpayers. They have to sell these things off eventually. That's an austerity measure. I think that's going to be very, very difficult to do. We've barely begun to sell off, I think, 150, 200 billion of the $9 trillion. And that coinciding with an elevation of the Fed interbank lending rate, has led to a decline of the S&P 500 by about 20%, 25%, depending on the particular day. Yeah. And that trend is likely only to accelerate.
Yeah.
So, could happen. We could have it, but the problem is our debt is so high that any such things, trying to sell bonds or mortgage-backed securities into the open market, especially quickly, or trying to elevate the interbank lending rate, especially quickly, by buying fewer bonds, ultimately is largely how it works. Then those actions are, with the amount of debt that we have, keeping the amount that we have of debt in mind, are going to be very destructive to asset valuations. So we can support the dollar, we can support our currency, but then a lot of the asset valuations have to decline. Mm-hmm. And that's also very politically unpopular. Economically and theoretically possible, should work, very politically unpopular.
Yeah.
Nobody wants to take their medicine. Another factor that could cause the U.S. dollar to be sought after as an investment, even temporarily, would be if there's a liquidity crisis. So a lot of banks, investment banks, a lot of investment banks, a lot of different financial entities, pensions too, even sometimes, they're investing in things on margin. So they've bought a certain amount of bonds or stocks, and depending on different rules and regulations, they're able to margin out anywhere between 30% to up to 10 to even 100 times, rarely, for certain commodities trades with certain conditions. The point is, the system's levered, and investment houses, traders, various people, they are institutions and individuals, entities. They've invested, and they've used investments as collateral for more investments, right? And when you have a levered system like that, it props up asset valuations, which is one of the reasons things are so overvalued right now. But if that system begins to collapse, if valuations of one major asset class that a lot of these institutions hold, or even multiple of them go down in value, which we've seen this year, bonds and stocks together have gone down about 20 to 30% since the start of the year. When you have that, it requires those same entities to sell off more of those assets to gain dollars, because they have to have dollars to pay down their dollar-denominated margin debt. Mm-hmm. Yeah. So temporarily, there could be a run on dollars or demand for dollars from large institutions, and even
do you see that happening?
Retailers. I don't know. It's been talked about a lot, and there have been really intelligent people who've brought that up as a possibility. I recognize that it could happen. I don't know that it will. And corresponding to that, just as a quick aside, the same people who believe that's possible, definitely they point to, I've mentioned previously that the dollar is basically an overnight treasury instrument. Mm-hmm. Well, that should extend throughout the duration curve. So if there's a run on dollars or a demand for dollars, it could theoretically also cause, and has in the past during different environments without inflation, has in the past caused a flocking toward longer duration dollar instruments, right? So 3 month, 6 month, 30 year even. So there could be a run on dollars and on bonds, possibly. Yeah,
Interesting.
and especially for bonds, because the yields have gone up or the value of bonds have gone down so far recently, so fast that there could be a technically inspired or a counter trend emerge to that. But that's an entirely different discussion.
It's interesting to think about, though.
It is. What's even weirder to think about it is recently the Dixie's gone up, and the dollar in some absolute measures has gone up, but then bonds have gone down, but that's part of the inversion of the yield curve, and
Right.
part of the process of some dollars being basically, you look at it, they're all dollars. There's dollars you're going to get at different times. So the dollar you're getting tomorrow is going to be worth this many dollars. The dollar you're going to get in 3 months is going to be worth this many dollars. The dollar you're going to get in a year is worth this many dollars. And all those valuations are screwy. And also, strangely enough, a lot of them are constant. Most of the bonds in the United States, they're trading at 4%.
Yeah.
In theory, there should be a curve, like we just described in the bonds video, 7% toward the longer end, let's say, or 6-7% at 30-year United States Treasury. So you get 6 or 7% a year every year for tying up your money for 30
so
years.
long, right?
But that's about 4%, as is the 1 year or the 2 year.
Right, it's
They're
like-
about the same. It's really screwy.
Yeah, and it's
It is.
even it's so complicated, to understand. I mean, I understand it, you understand it. I
Well,
hope
I
our
think I
viewers
understand.
understand it, but it's just so nebulous because it's all about time, the time value of money, and relative
Right.
to everything else, and there's just so many factors that affect the value of the dollar. It's actually very, very convoluted.
Right.
But anyways, carry on. So
there could be a run to dollars and a run to bonds if there's a liquidity crisis. I'm open to that. I don't know. It really depends on a lot of factors that we that are unknowable. I don't know how leveraged certain investment houses are, what their reactions might be. We're trying to anticipate in aggregate the actions of tens of thousands, maybe even hundreds of thousands of people with significant wealth and a stake in that wealth, what they're going to do in the future, and what kind of narratives they're going to be exposed to, which ones to believe and disbelieve. I think it's impossible to predict, but it could happen. So I'll acknowledge that. To pay off margin debt. Now, once that margin debt goes away, there could still even be a run on dollars, just as if they're viewed as a safe haven. As an alternative, let's say stocks are down, well, they are this year, 20, 25%, 30%. Let's say they stay down, and let's say even the next year they're down another 20%. How many investors or large investment houses will feel pressure externally or internally to say, okay, well, I've already lost money, I've lost money again, or lost currency anyway, or the dollar-denominated value of my bonds has gone down. So in light of that, should I just start putting some of that over to dollars to keep it safe in case there are continued declines? That could happen, irrespective of margin debt.
right.
So, and that's what they call the safe haven bid under dollars, and sometimes under precious metals too, oftentimes.
Yeah.
Another thing that could happen is if there's a reinstitution or reinvigoration of the petrodollar system, if there's an essential commodity like energy, oil, natural gas, or an essential agricultural commodity, potentially, that another country produces, but they determine for military alliance reasons or for political reasons that they wanted to sell that product only in U.S. dollars, that would create or spark an increased demand internationally for dollars, and that's why that's what the petrodollar system basically was with Saudi Arabia.
It still is it not? I know this relationship is strained, but don't they only transact in U.S. dollars?
I have to check that. I think they started selling some of it off to China as denominated in yuan.
Okay.
But you know what? I might be wrong on that. I'm not sure.
And regardless, it still is at least in part, it's still active.
Yeah, in part, yeah. Or alternatively, instead of oil and natural gas, you could look at theoretically if transmission capacity was increased or battery storage technology was increased. If there's a nuclear country with a lot of nuclear power plants, they could export their energy and they could, in theory, denominate it in dollars. But it wouldn't have to be energy. It could be an essential agricultural product like wheat or soybeans, something like that. I don't know, copper, maybe a base metal. So who knows? But theoretically, if a lot of countries or a major producing country, commodity country like Canada, or theoretically Russia, although not likely in practice, or Brazil, if they decided to start exporting a lot of their products in dollars, that could kind of reinvigorate demand for dollars. Mm-hmm. And of course, the last thing they could do would be tax rates. So if tax rates are increased, locally as monetary policy. Now, fiscally, you may or may not agree with that, but just looking at it purely in monetary policy, if there's an increase in tax rates that is not so high of an increase that it decreases production by people intentionally dropping out of the system or decreasing how much they work, or companies intentionally going to other countries to avoid the taxes. So as long as the tax rate rises aren't too high that they decrease economic production, that should siphon off dollars from the system, and in so doing cause the value of the remaining dollars to increase.
Yeah.
On balance, it's hard to know what's going to happen on a regular basis, but you can keep these general principles in mind looking forward into the future, and as you read through and digest the news and current events, and kind of get an idea of what might happen with the dollar. In a general sense, it's probably not, in a general sense, it's probably a bad idea to hold on to too many dollars. For example, 50, 60, 80%, 100% dollars could be a mistake, especially if there's a substantial inflationary environment. So having something to counteract that could make a lot of sense. On the other hand, holding on to $0 is not an option for anybody.
Right, not here.
Or very few people. So it's essential to have some amount of dollars, and determining the ideal allocation of dollars for you in your personal life, and then secondarily in your investment portfolio, is I think very, very important, and taking these considerations into mind, and how the dollar is perceived, how the dollar is valued through proxy measurements such as the DXY and the Bloomberg Dollar Index is essential. And then also taking into account, or it's wise to take into account also the factors that can impact the dollar as well.
Yeah.
Yeah.
I'm going to make a bold statement. My bet, for the record, is that the dollar is weakened over time.
I don't know if that's that much of a bold statement to make.
Okay, maybe it's not then. I don't know.
If you want to be really bold, maybe suggest how much it could be weakened and against what, how you'd measure that, and what kind of timeline you see it happening in.
Oh, I don't want to do all that. Isn't the statement that they say, like, don't ever, if you're going to make a prediction, do either a number or a date, but never give both.
Never give both.
I'm not giving either.
I'll be bold then. I'll suggest that the DXY could probably return pretty reliably back to the 90s, and probably eventually to the 80s as well. At some point, of course, that's contingent upon a lack of implosion of the Eurozone economy. But, well, no, I didn't want to make that prediction because it's so hard to say.
We're going to keep you guys guessing.
What I will predict is that the DXY chart's going to look pretty crazy, because there's going to be a lot of currency fluctuations as they all debase rapidly, but at different unpredictable rates. So we could see DXY go to 120, 150. We could see it go back down to 50, or not back down to 50. We see it go down all the way to 50. It's usually stayed, I think, between 70 and 110, 120. We could see it fluctuate all over the place as different countries, to paraphrase something I believe I heard Mike Maloney say, as they all race to the bottom against the value of real money.
Wow.
Some of them will go leaps and bounds ahead of the other as they introduce ever more foolish monetary and fiscal policy. In an inflationary environment, maybe that's not the best thing to do, and that's been criticized. But I don't know. What do you think about it?
I think you know what I think about it. I think you should sleep on it, but don't sleep on it.